Hello all and welcome back. All right, today I'm going to make a responsible video. Now my disclaimer is that that's not the way that I personally invest. I'm a bit more of a loose cannon. I sell a lot of options. I get in and out of momentum stocks. I don't hold things for very long, it doesn't seem, but I'm not going to do that today. Today this is going to be a responsible video where I talk about the sort of portfolio that I'd construct if I were a bit more conservative or maybe already in retirement. Let's say I was living off of a fixed income or a pension, and I was using like maybe dividends to supplement my income that I did have coming in without trying to lose any equity. I wouldn't go into something like QYLD or RYLD or XYLD because those tend to decline over time, the underlying share price, unless of course you're in a bull market. But they do pay great monthly dividends, but that's not what this is going to be about. It's going to be about dividend players that give you some growth over time. And I will say that when I was researching this video, I did learn some things that are going to be useful to me, and I'll substitute some of these securities in for the bond holdings that I currently have that kind of that I use as my cash position in this particular portfolio. And I have noticed that a lot of the viewers for this video are kind of like like for my videos in general, through the demographics, they're kind of like retirement age folks. They're kind of like myself. And maybe this is the kind of video that some of you would like to see. So that's another reason why I'm making this, because this is, after all, YouTube. It's not MeTube. And finally, what if there's time after all this, I'll go ahead and discuss what I do, like when I sell a stock. There's a lot of channels out there that talk about when to buy a stock, but there aren't that many that talk about when to sell a stock. And I'm going to show you a stock that I sold, why I sold it, and what are the indicators that went into me selling this position. And thanks as always for everyone for supporting this channel and subscribing. It's definitely appreciated. So let's go ahead and get started on this responsible portfolio. Now, first, I'd like to show you this isn't like some sort of surrender video. I actually do pretty well with my methods, but it is, I understand it's unique to me. It's not for everybody. And here's my realized gains from, say, March 11th on through today. And the reason why I chose this is the day that so my sister-in-law, I made a bunch of money from NVIDIA and got her a plane ticket to come over to England, and we went on a vacation here. Start on the 11th of March. And one thing I like to do when I go on vacation is see if I can't win all my money back and pay for the vacation and make it free. It's sort of like I also got a bunch of tickets last week for Tottenham versus Man City. I got 3 tickets. I said, and I couldn't believe I got them, so I thought it was like divine intervention. I think God wants me to sell puts and make this money back, and then I did. I got those tickets for free too. But you could see that from say March 11th through March 23rd, I made $17,000, right? Now I also lost 1,000 in here. I guess overall I earned 18,000, lost 1,000, and netted 17,500. And you can see that a lot of this stuff that I do here, it's puts and calls, puts, calls, puts, calls, and I just try and make little bits of money I just try to make little bits of money. And here's the stock that I sold. I sold Novo Nordisk. Again, I like the puts on Palo Alto Network. And let's say the day before FedEx reported, I thought, well, let's go ahead and make a little bit of money. And then I sold a put on Thursday night, made $336 the next morning. Now, this is a portion of my portfolio that I like to mess around with. And I'll say that I started this portfolio in, say, March of 2023. I actually caught it at the market low. I put in $5,000, and then when I didn't lose that, I put in another $6,000. And ever since then, I've been putting in another $500 every 2 weeks for a total of about, what would that be, about $59,000 or something like that. Now, this portfolio in about June of last year was about $88,000. And right now it's sitting about $152,000, like enough that my wife asked me how much is in that portfolio, whereas before she didn't used to ask. And then I also moved a bunch of money in there, and I do a lot of fixed income stuff. And the fixed income that I use, I just use treasuries. I got 264,000 treasuries, and they're just 1 month bonds. Like this one here, it expires on April 9th, right here. and the next one expires on April 11th. And the reason why I have them expiring at these times is I don't see a lot of market catalysts out there, anything that's going to propel this market higher until the middle of April. And then come the end of April, you'll start getting your mega cap tech earnings. And I think then we're off to the races again. But I just think we're going to go through a period of consolidation. And 5.4% annualized is a pretty good rate. However, the equities I'm going to talk about in this video, I'm seeing they're going to substitute for this fixed income portion of my portfolio. And the type of securities that I'm looking for to build this portfolio with, because this is actually a bigger portion of my portfolio than the one that I choose to gamble with and show people videos of. And maybe that's why I'm so cavalier with my, just splashing money around. But the bigger part of this portfolio is kind of more of a responsible version, like they said, like I just showed you, it's more in the bonds and that sort of thing. And what I want to do from this part of the portfolio is I want growth, I want safety and security. I want monthly dividends if possible. Some equities pay monthly dividends, or ETFs, they pay monthly dividends, and some pay quarterly. But if possible, I'd like the ones that do monthly. I'm going to pretend that I have $100,000 to construct this portfolio with, and I'm going to divide them evenly among 5 of the stocks that we're going to discuss, or ETFs that we're going to discuss today. The contenders that I've decided to, just after some research, is I want to establish a baseline. That's going to be our 1-month treasury. And right now our treasuries are sitting at 5.4%. I'll just let you know. So on $100,000, after 1 year, you'll have $105,400, of which $5,400 will be essentially dividends that you can use. So you'll have $105,400. So you got to do better than that, right? You got to do better than that. So the other ones I was looking at is looking JPI, JPQ, DIVO, DGRW, SCHD, NOBL, COWZ, Microsoft, Visa, and Pepsi. All right, so this is what I'm going to try and pick 5 of these that I would choose in my own personal retirement portfolio to supplement fixed income. So let's have a look at the first one here. So the first one's going to be JEPI, and it's a covered call ETF. And what does that mean? Well, what it means is that if they make money, you make money. And so covered calls are, they rely a lot on what's called the volatility index. And the more volatile a market is, the more money you'll get back from a covered call. So if you look over here over 5 years, you can appreciate that right now it's sitting at 13. Essentially, when the VIX is low, the market's going up. When the VIX is high, the market is going down. And so right now, we're in the beginning stages, I think, of a bull market, a multi-year bull market in all likelihood. And so right now the VIX is quite low, but it will spike from time to time. And a lot of the premiums that you get from covered calls are dependent upon this volatility. And JEPI being a covered call ETF, it's going to pay less per share now than it would in times of volatility, i.e. when the market is going down. It's going to pay more in a bear market than it will in a bull market. So let's discuss a covered call real quick. So like right now, I have, say, a covered call. I own these equities. You can see that what I own. I own Amazon, I own Shake Shack, and I own Palo Alto Network. And whenever I buy something, I'll insure it. I'll sell a covered call against the underlying, and it just kind of helps me maximize my gains. I've also bought a put against DWAC, of which I'm up $119 on that put. I actually already sold 4 puts and made $100 off of those, but it was just too much and I had to buy another one. All right. So let's go ahead and discuss what it means to sell a covered call. And this is important to understand so you can understand how JEPI makes you money. And so you go over here, I chose NVIDIA because it's the one I'm always selling calls and puts on. And I choose call. Let's say I owned 100 of these shares. I'm going to sell it to open. I'm going to sell 1 contract. 1 contract equals 100 shares. I'm going to give it an expiration date. Sure, next Friday works just fine. Contracts expire every Friday. You can see there's 7 days apart. Most are weekly, some are monthly, and some are like the S&P 500, the SPY, that's daily. But by and large, just think of contracts expiring weekly. But when you talk about the big stock market expiration date, that's once a month. And I think that was last Friday. I'm not sure. It was either last Friday or the Friday before, but in any case, they expire about weekly. They expire on the Fridays. Now, NVIDIA has a current share price of $940. Let's say I own this, but I don't really want to get rid of this stock. So let's say that I'll sell you a covered call of a strike price of $960. So what this says is if that NVIDIA is over $960 on the 28th of March, I will go ahead and sell you my shares for $960 a piece. But if NVIDIA is under $960, say $950, I will keep your money and keep my shares of NVIDIA. So ultimately, when you're selling covered calls, what you want to do is take this money and keep your shares. So NVIDIA is currently $940. They would pay me $16.53 per share, or $1,653 per contract. Should NVIDIA be under 960, I get their money and the shares. If it's 970, I sell everything for 960 a piece, but I still get to keep their money. What's the break even though? The break even isn't 960, it's 960 plus 1653, or 973 a share. So if it's at 970, I can still net $350, right? But if I want to, or I can sell everything, keep all the money. The decision is mine. I would, in my case, I probably just keep the shares, net the 350, sell another call, and live to play another day. But that is what a covered call does. So first up on this list is going to be JEPI, or JEPI. It's a derivative income strategy ETF, or in this case, a covered call ETF. It's rated 5 stars by Morningstar, and why wouldn't it be? It's absolutely fantastic. It's got a current rating of 5 stars, and over 3 years, it's 5 stars. It doesn't have a 5-year rating or a 10-year rating because it hasn't been out that long. It's only been out barely 3 years. Over the past year, it's made 7.6% of equity appreciation over the last 3 years, or the length of the duration of that this ETF has been around. It's up 1.45%. You can see that it pays out monthly. This month it was in May it was 42 cents, and then in June it was 37 cents, and then here recently it was 30 cents, 30 cents. 43 cents, but in times of high volatility, like we were talking about with the VIX, it's going to pay more. That was 62 cents. This would be 50 cents, and this would be 52 cents. So when the market is going down, this pays a lot more money because you're getting money for that volatility. The next up on this list is going to be JEPQ. JEPI trades covered calls on the S&P 500, whereas JEPQ trades covered calls against the NASDAQ. It's going to be a bit more volatile. It's going to have a little bit more of a return every month on your dividend income. You can see where JEPI was 30 cents, this one's 38 cents. It's because the NASDAQ is inherently more volatile than is the S&P 500. Over 1 year's return here, we can see it was up 23.18%. It has not been around 3 years. It started off in May of 2022. It also pays monthly, just like JEPI does, but like I said, it has a little bit more of a return, and it doesn't seem to have a Morningstar rating just yet. All right, next up on this list is going to be DIVO. DIVO is also another covered call ETF. It's managed by Kevin Simpson, who you might know from CNBC. He's a frequent contributor on that channel. It's trading right now for $38.70 a share. It also pays out a monthly dividend. It's rated 5 stars by Morningstar. The 3-year rating is 5, and the 5-year rating, the 3-year rating is 4 stars, and the 5-year rating is 5 stars. It pays a monthly dividend. It's a less expensive stock, so this is going to be a little bit less, but it pays 15 cents. It seems about 15 cents every single month. It's got a 1-year return of 10.95% and a 3-year return of 13.36% and a 5-year return of 32.62%. The 3-year return is interesting because you want to see how these things perform during a market downturn. In this case, 2022 was abysmal, and you can see that it started off 2022, it was sitting at $38.20, and at the end of 2022, it was sitting at $36.63. So it really didn't lose much. And if you include the dividends, it actually made money on that terrible year. Next up on this list that I really like is this DGRW. It's the Wisdom Tree Growth Large Cap Dividend Growth ETF. And it's rated 5 stars by Morningstar overall. It's got a nice 3-year rating. Its 5-year rating is also good, 4 out of 5, and its 10-year rating is 5 out of 5. It pays out monthly dividends. It looks like it's about 8 cents to 10 cents. That one was 22 cents to 10 cents. But this is not a covered call ETF. This is simply, it's a large cap dividend ETF, but it's going to be mostly of growth stocks. Let's have a look at its holdings real quick, so I'll give you an idea of the sort of thing that this one might hold. It holds Microsoft, Apple, AbbVie, Broadcom, Johnson & Johnson, Home Depot. So it's a nice distribution of growth and growth plus some dividend income. You got healthcare, and you've also got a lot of staples in here. You got Johnson & Johnson, Coca-Cola, Pepsi, and so it's a healthcare, growth, staples, ETF. But you're going to see from the numbers here, it actually does really well, which would be the reason why it's rated 5 stars. The 1-year return on this ETF is 24.21%. The 3-year return is 35.95%. And the 5-year return on this monthly paying dividend ETF is 76.24%. You can see why Morningstar likes this one and gives it the 5 stars. Another one on this list is going to be SCHD, and that's going to be your Schwab US Dividend ETF, and it's simply just a large cap blend ETF, similar to DGRW, but in my opinion, not quite as good. It pays out its dividend out quarterly. It looks like every quarter you get 74 cents or 65 cents that quarter, or so roughly 20 to 30 cents per quarter. Over the past year, it's up 9.75%. Over the past 3 years, it's 10.28%. And over the past 5 years, it's up 51.84%. Also on this list is going to be, I included the Dividend Aristocrat ETF Noble because I thought that sounded like a pretty good one. And so this a Dividend Aristocrat would be a stock that has been increasing its dividend every year for the past 25 years or more, and that would be considered an aristocrat. So if you're interested in those sorts of stocks, one good place to go would be go to your Noble ETF and then check out its holdings, and you can see that Caterpillar, Target, Lowe's, Dover Cornings, all of these have been increasing their dividends every year for the past 25 years, making them aristocrats. And then Noble actually holds the basket of these stocks. Now, over the past year, this ETF has been up 11.92%. It pays out a dividend every quarter. Like I said, that was 66 cents. This month, that quarter there was 52 cents. Over the past 3 years, we've had a return of 17.6%, and over 5 years, we've had a return of 47.01%. Also on this list that I was going to look at was going to be cows. And don't worry, I'm going to put all this together in a nice PowerPoint thing so you can have a look at this, and I'll get all the numbers together. But I'm just kind of giving you an idea real quick before we start just looking at pages and numbers, what these are, looking at it in graphs. And this is a very interesting ETF, in my opinion. I think this one's fantastic. And so does Morningstar. It has rated 5 stars at the 5-year, 3-year, and current. It trades for $57.11 a share. It's mid-cap value. But what they are is, this is an ETF of free cash flow machines, right? So if your company makes a lot of free cash flow, you can qualify to be in this ETF. And so 1 year return would be 24.1%, 3 year return on cows is 41.4%, and the 5 year return is 97.41%. If we look at it through the market downturn of 2022, we can see it started the year at 48 bucks. It ended the year at $46. So it actually performed really well in a market downturn. If we look at the holdings, like what are going to be your free cash flow machines? Well, you're going to have Valero, 3M, Marathon Petroleum, Vistra, Altria, EOG, Exxon, CVS. A lot of oil and gas stocks seem to be in this ETF, but it's a very good one, as you'll see in the slides coming up here. And finally, we're going to look at Microsoft, Visa, and Pepsi. And Pepsi because it's a traditional holding in a lot of retirement portfolios that are looking for some growth and some dividends. All right, so let's go ahead and have a look at this PowerPoint presentation I'm talking about. All right, so the first one on this list is going to be JEPI. It's a covered call ETF. Now remember, we're starting with $100,000. We're going to divide this up 5 ways. So we're going to buy $20,000 of each of these securities, and then we're going to select which 5 we're actually going to take with us to the bank, as it were, and just kind of put it in our portfolio. JEPI is a covered call ETF. It has a monthly dividend payout of 35 cents per month per share. Now, remember, I went through that list that showed it paid every month. It's different every month on these, of course, dependent on volatility. But right now, we would say over the last like 8 months or so, it's averaging about 35 cents per month per share. Its 1 year ETF appreciation is 7.6%. It has a current share price of $57.46, which means that for $20,000, you can get 348 shares. Times 35 cents a share would be $121.82 a month for $20,000 worth of JEPI. The annual dividend return on that would be $1,461. That would be a dividend return rate of 7.6%, and a total 1 year return rate of $23,091 would be the total at the end of the year. So I guess the return on that would be $3,091. Not a bad return on $20,000 invested. The 3 year appreciation, like if you held this ETF for 3 years, the 3 year chart shows it went up 1.45%. So JEPQ is another covered call ETF. Again, it's the NASDAQ one. It has a monthly payout. It's a little bit higher than JEPI. We'll say 37 cents a share. The 1 year ETF appreciation on that one's 23.18%. Makes sense. We've been in a bull market, and a lot of the growth stocks are in the NASDAQ. The current share price there is $54.33. That would give us, on $20,000 invested, we get 368 shares times 37 cents a share, gets us $136.20 of dividend return on JEPQ per month with $20,000 invested. The annual dividend return on that's going to be $1,634. The rate of return is 8.18%, and on $20,000 at the beginning of the year, you'd have $26,651 at the end of the year. Now, it doesn't have a 3 year return, but since it became an ETF in May of 2022, and since then it's had a overall return of 10.26%. Obviously, this one's when the stock market goes into a bear market like it did in 2022, the underlying equities or the underlying holdings are going to go way down, meaning that the 1 year return is 23.18, but the almost 2 year return is 10.26. So it did not fare well in the market downturn. DIVO, that's the Kevin Simpson one. This one is also a covered call ETF. It does have a monthly payout of 15 cents a share. The 1 year return on this is 10.95%. It has a current price right now of $38.70. With $20,000 worth, you can buy 516 shares, 15 cents a share return every month. It means that every month it'll pay you $77.52 for an annual dividend return of $930 and a return rate of 4.65%. Your $20,000 would be $23,221 at the end of 1 year. It has a 3 year appreciation of 13.36. Like we said, it fared well through the market downturn of 2022. It has a 3 year appreciation of 13.36% and a 5 year appreciation of 32.62%. Next up on the list is DGRW. That was the large cap growth ETF. This is one I like quite a bit. It's got the monthly dividend payout of 10 cents on average per month per share. The 1-year ETF appreciation on this one is 24.21%. It's got a current price of $75.97, which would get you 263 shares times 10 cents per month per share, which means that your dividend would be paid out $26.30 a month for an annual dividend return of $315.60, which is a dividend return rate of 1.58%. Your $20,000 at the beginning of the year, which should be $25,234. The 3-year appreciation on this ETF is 35.95, indicating it held up pretty well through the downturn of 2022. And the 5-year appreciation on this one is 76.24%. Next on the list is SCHD. It's a diversified ETF of large cap stocks, has a quarterly dividend payout of 60 cents per quarter or 20 cents per month. The 1-year ETF appreciation of this one is 9.75%. The current share price is $79.38. It has a monthly dividend return of $50.20, because $20,000 will get you 251 shares times 20 cents. Gives you a monthly return of $50.20 or $602 a year. That would give you a dividend return rate of 3% annualized. The 1-year $20,000 at the beginning of the year would be $22,608 at the end of the year. The 3-year appreciation on this ETF was 10.28%. Indicating it probably went down a bit during the market downturn in 2022. And the 5-year appreciation is 51.84%. Next on this list is going to be our Dividend Aristocrat ETF, NOBL. Quarterly dividend payout of 40 cents per quarter. The 1-year ETF appreciation on this one was 11.92%. The current price of this stock is $99.64, meaning that for $20,000 you can get 200 shares times 13 cents per share per month, would get you a monthly return of $26.67. It pays out quarterly, but it would be $26.67 monthly or $320 per year for a dividend return rate of 1.6%. $20,000 at the beginning of the year would be $22,742 at the end of the year. The 3-year appreciation on these shares was 14.91%, and the 5-year appreciation was 47.01%. Next up on the list is one that I really like here. This is the Free Cash Flow ETF, COWZ. Quarterly dividend payout of 22 cents per quarter. 1-year ETF appreciation is 24.1%. The current price of this ETF is $57.11 per share, meaning that you can get 350 shares, 7 cents per month per share, get you $25.66 per month per share of cows, or $308 a year for an annual dividend return rate of 1.54%. The total 1-year return on this, because it has so much ETF appreciation, is $25,202. 3-year appreciation on this is 41.4%, indicating that it wasn't affected much by the downturn of the stock market in 2022, and the 5-year return on this is 97.4%. Next up on this list is Microsoft. Of course, this is a stock that should be in everybody's portfolio, and for some reason it's not in mine yet. I'm going to get it next month. It's a growth and cash flow machine. It has a quarterly dividend payout of 75 cents. It has a 1-year appreciation of 56.6%. The current share price is $428.50. It has a monthly dividend return then of 25 cents. For $20,000, you could buy 46 shares. The monthly payout would be $11.50. The annual return would be $138. That would be a dividend return rate of 0.069%. The total 1-year return on Microsoft, if you started with $20,000, would be $31,536. The 3-year appreciation on this is 86.13%. And the 5-year appreciation is 263.52%. You're never really going to get a great deal, in my opinion, on Microsoft. It's sort of like going out and buying a house. You know, you're always going to have to kind of pay what it's worth. You're never going to see it, or it's going to be very rare to see it just collapse, and you can get a great deal. So now is as good as any time to go out and buy Microsoft. Same thing said for Microsoft can also be said for Visa. You're very rarely going to catch a huge dip in this one. You're always going to pretty much have to pay what this one is worth. It's a reliable safety stock with a quarterly dividend payout of 52 cents per quarter. It had a one-year appreciation of 27.62%. The current share price is $283. That means you can get 70 of them for $20,000 with a monthly dividend of 17 cents or an annual or a monthly dividend payout of $11.90. The annual dividend return would be $142.80 with a return rate of 0.0714%. Your $20,000 at the end of the year would equal $25,706 with a 3-year appreciation on this equity of 36.91% and a 5-year appreciation of 81.36%. Next on this list is going to be just a traditional old just dividend stock that people think of, just a traditional dividend stock. Quarterly payout, $1.27 per quarter. The 1-year depreciation on the stock it went down 3.36% this past year. It has a current share price of $172. The monthly dividend return would be 42 cents. You can have 116 shares. That would be $49.11 a month or $589.28 per year. The return rate would be 2.95%. Your $20,000 at the beginning of the year would be worth $19,898. This goes to show you that when you're going to have a bull market and you're going to have high interest rates, it's going to impact your consumer staples and your utilities and your REITs it's going to impact these things because you can get a better return on bonds. Your risk-free rate of return just isn't there with these sorts of stocks in a bull market with high interest rates. Now, in a bear market with high interest rates, these ones are just fine. They don't seem to lose their value. But under our current economic conditions, I wouldn't suggest going into these just yet, at least not until they cut rates and make these a more attractive offer. The 3-year appreciation on Pepsi is 27.9%, indicating it had a very good 2022. Like I said, these are bear market stocks. The 5-year appreciation of Pepsi is 40.37%. Now, if I had to construct a 5-stock portfolio using $100,000 and I was going to divide $20,000 into each, this is what I would go with based on my findings right here. I'd go JEPQ, DGRW, JEPI, Cows, and Microsoft. The 1-year dividend return on this, so on $100,000, I would get back $4,646 in cash. That I could either use it to pay bills or reinvest. The 1-year return on $100,000 using this portfolio would be $132,695. If I would take the 5 highest dividend payers on the list, that would be JPQ, DGRW, JEPI, Devo, and SCHD. I would get $5,732 in dividends that year with a 1-year total return of $121,786. That would be the value of the portfolio at the end of the year if I just reinvested these dividends. Treasuries would give me $5,400 in cash, or almost the equivalent of the dividend return. However, my return at the end of the year would only be $105,400 versus $121,786. It's the reason why I'm going to steer away from treasuries for now and probably go into more of these right here. I'm thinking I might add JEPQ, I might add Cows, I'm definitely adding Microsoft. But in a bull market, I really want some of these growth ones. I like DGRW, I like JEPQ in a bull market like we have right now. In a bear market, maybe JEPI might be a better one to go with, and certainly some of those consumer staples. But DGRW is also good in a bear market because remember, it held a lot of those oil and gas stocks, and oil and gas stocks hold up really well in a bear market. All right, let's go ahead. I said I'd say when I go what stock I sold. Of course, that was Novo Nordisk. I revealed that a little bit earlier. Let me show you why I sold that stock and when I decide to sell a stock, because I do sell in and out of equities pretty often. So the stock that I decided to sell out of was Novo Nordisk. It's the maker of Ozempic. They also make Wegovy, just basically those GLP-1 stocks that are pretty hot right now. As a result of it being kind of a hot stock, you can see the graph went from the lower left to the upper right. But here recently, you can see that this stock is making a series of lower highs and lower lows. So I don't like this pattern. And ordinarily, this sort of thing wouldn't really bother me, but the stock is overvalued. It's the reason why it gets 1 star by Morningstar. We're talking about a healthcare stock that trades at a current price to earnings ratio of 47, which is more than double that of the S&P, and a forward PE of 38, indicating it has some growth, but it's not like Nvidia type growth. It's got some growth. It's overvalued. And so when I see these sorts of things where you're getting lower highs and lower lows, it makes me kind of nervous. It makes me think I got to get out of this one, and that's why I went ahead and sold out of this position. I made about, I want to say, $1,900 on this position just selling out. So you always want to get out with that money when the momentum is gone. All right, yeah, so that's going to pretty much do it for this week. I can see where I'm going to be taking my conservative part of my portfolio, maybe not be quite as conservative. I do see that the market tailwinds will begin again when the earnings season starts in mid-April. We had a great week last week with the GTC conference, Jensen Wang. But I think that it's probably going to consolidate or pull back a little bit. You never know, because there's a lot of money sitting out there, and maybe it's every little dip's going to be bought up and we don't get consolidation. It continues to go up. But either way, I'm playing it this way. I'm going to be playing it with a lot of bonds at the moment and a small equity portfolio that is going to grow through the middle of April as earnings season starts to pick up again. All right, so if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time and have a great weekend, everybody. Bye.